Jamie Dimon warns, can you and your company handle 6% or 7% or higher long-term rates? Why QT will lead to more bank failures. White House says 8 million jobs will be lost if U.S. defaults on its debt. The 3-month Treasury bill yield has moved up to 5.4%, its highest level since January 2001. A year ago, it was at 1.03%, and 2 years ago, it was at 0.01%. A sign that people are worrying about debt ceiling talks falling apart, even as Biden and McCarthy tried to assure the public that the U.S. won't default. We are 9 days away from the debt ceiling deadline. As of right now, there's no deal. Here are the effects of a breach. According to Moody's, first week, 1.5 million jobs lost, raising the unemployment rate from 3.4% to 5%. Within 2 months, 8 million jobs lost, raising the unemployment rate from 3.4% to 7.8%. U.S. 30-year yield rises to 4% the first time since March. Why Jamie Dimon warns everyone should be prepared for 7% or higher rates. Why QT will lead to more bank failures. I will explain it all right after this.
How you like that? How you like that? Nah, look at you, now look at me. Look at you.
Welcome back to the Audacious Money Witch channel, where we talk about macroeconomy, stocks, bonds, and commodity markets. If you like any of these topics, you are intelligent. That's why you're here, and you know what to do, and push my button if you like what you see in today's video. Because you're already a success, it is done when you join the Audacious Money Witch Club. This video is brought to you by my new website. If you're a good boy, go to audaciousmoneywitch.square.site to add more meaning into your life. If you play your cards right and completely submit, like my good boys do, then I will take you under my wing. Author of best-selling books, Goddess Cheryl. My good boys always get rewarded handsomely. You are such a good boy. You like hearing that, don't you? You want to get into the bookstore. You want it to be real. You want it to be true. You want to join the Audacious Money Witch Club, don't you? U.S. default is possible this Friday. Treasury has $60 billion left. If spending continues at current elevated pace, the balance will be negative $18 billion by Friday. The U.S. Treasury has $57 billion in cash on hand, while the government carries $31 trillion in debt. That's the equivalent of an average person having $1,000 in cash on hand and $543,859 in debt. Isn't that scary? Investors are tired of waiting for recession and are asking when they can buy stocks again. We've been positioning for this recession for 6 quarters. We're at the point where the average money manager and investor is mostly in defensives. This explains this AI stocks rally. Don't be fooled into thinking this year's stock rally is the start of a new bull market. Looming behind market fears over the prospect of a historic U.S. default is the less discussed risk of what would allow a deal to resolve the debt ceiling impasse. Many on Wall Street predict lawmakers will ultimately reach an agreement, likely averting a devastating debt default, even if it goes down to the wire. But that doesn't mean the economy will escape unscathed, not just from the bruising standoff, but also as a result of the Treasury's efforts to return to business as usual once it can ramp up borrowing. Treasury will need to scramble to replenish its dwindling cash buffer to maintain its ability to pay its obligations through a deluge of Treasury bill sales, estimated at well over $1 trillion by the end of the third quarter. The supply burst would quickly drain liquidity from the banking sector, raise short-term funding rates, and tighten the screws on the U.S. economy just as it's on the cusp of recession. By Bank of America Corp's estimate, it would have the same economic impact as a quarter-point interest rate hike. Higher borrowing costs in the wake of the Federal Reserve's most aggressive tightening cycle in decades have already taken a toll on some firms and are slowly crimping economic growth. Against this backdrop, we are especially wary of an eventual move by Treasury to rebuild cash, seeing potential for a massive reduction in bank reserves. My bigger concern is that when the debt limit gets resolved, and I think it will, you are going to have a very, very deep and sudden drain of liquidity. This is not something that's very obvious, but it's something that's very real. And we've seen it before that such a drop in liquidity really does negatively affect risk markets, such as equities and credit. The upshot is that even after Washington gets past the latest standoff, the dynamics of the Treasury's cash balance, the U.S. Fed's portfolio runoff program known as quantitative tightening, and the pain of higher policy rates all stand to weigh on risk assets as well as the economy. After a debt cap resolution, the U.S. cash stockpile, the Treasury general account, should soar to $550 billion as of the end of June from the current level of about $60 billion and hit $600 billion 3 months later, according to the department's most recent estimates. A rebound will affect liquidity across the financial system because the cash pile operates like the government's checking account at the Fed, sitting on the liability side of the central bank's balance sheet. When the Treasury issues more bills than it technically needs during a certain period, its account swells, pulling cash out of the private sector and storing it in the department's account at the Fed. Another important piece of the puzzle is the Fed's reverse repurchase agreement facility, dubbed the RRP, which is where money market funds park cash with the central bank overnight at a rate of just over 5%. That, programmerly over $2 trillion, is also a liability at the Fed. So if the Treasury account increases, but RRPs drop, then the drain on reserves is lower. Money funds' tendency to keep cash in RRPs will most likely persist, which could mean a sizable drain in bank reserves when the Treasury's cash jumps. And that would come as major central banks have already been siphoning off liquidity through aggressive tightening campaigns and efforts to unwind their balance sheets. JP Morgan says failure to reach a debt limit deal could cause a worse stock sell-off than 2011, when the S&P 500 fell 17% in just 2 weeks. Under QT, as Fed reserves shrink, deposits must follow. As such, deposits are either forced to shift into T-bills or are destroyed, bank failures. Thus, the bank crisis is an inevitable side effect of Fed tightening. By now, everyone knows that when it comes to banks failing and capitalizing on it, few are as experienced as JP Morgan, aka JP Morgan, which now has more than 13% of the nation's deposits and 21% of all credit card spending. In other words, there has never been a bank that is more systematically important than JP Morgan. And with every small bank failure, Jamie Dimon's Goliath is only getting bigger. During JP Morgan's Investor Day on Monday, the billionaire CEO said, "We haven't been through quantitative tightening, so we really don't know what's going to happen to deposits at all. We've never had QT before. It just started, okay? And you see huge distortions in the marketplace already. We've never had the Fed in the market like this with that RRP program ever. They have $2.3 trillion basically lent out to money funds. So I think people should build into their mindset that they may have to move deposit beta more than they think and manage that. So I mean, if I was any bank or any company, I'd be saying, can you handle higher interest rates and surprise in deposits, etc.? By the way, deposit beta, as Jamie calls it, for those unfamiliar, is a polite way of saying bank run, which is a less polite way of saying bank failure. It is no surprise then that it is Jamie's sincerest wish for rates to keep rising. Where do you think the rates will go? We are shifting from a very significant tailwind of global central bank liquidity over the last 6 months to probably a significant headwind. What we really care about is reserves, which should be falling, so I'm strongly leaning to risk off at this point. Here is my client Teddy Eazzy's book, Wicked Pussy Perfume. It is a femdom novel and it's about money, the stock market, and stockings. Such an amazing author with such incredible content. Order your copy today. And my book, Believe You Are Worthy. You are such a good boy for watching my video right till the end. Bye.